It's 6:47 a.m. and Daniel hasn't slept. His HR software just pinged him with next year's health insurance renewal. The number on the screen, 11% higher than last year. He's got 12 employees, 12 people counting on him for coverage. And right now, he's staring at a math problem that doesn't add up. This is happening to small business owners across the country right now, and today we're going to talk about why and what some founders are doing about it. Here's a number that should worry you. In 2026, the median premium increase for small group health insurance is 11%. That's not a typo. 11%. And that's the median. Some insurers are proposing increases of 20%. A few, over 30%. For a business running on thin margins, that's not just a budget problem, it's an existential threat. But here's the thing, not everyone is getting crushed. Some founders are finding an exit, a strategy that barely existed 5 years ago. It's called an ICHRA, and if you haven't heard of it, you're about to. Let's back up and understand what's actually happening in the small business insurance market. Because this isn't random, there's a pattern here, and it's getting worse. Industry analysts call it a death spiral. Premium costs go up, so the healthiest businesses, the ones with young, fit employees, drop their coverage. Makes sense for them. But here's the problem. When healthy businesses leave, the risk pool gets sicker. The people remaining cost more to insure. So premiums go up again, and more businesses leave, and the pool gets sicker, and costs go up further. That's the spiral. Once it starts, it's very hard to stop. According to the Peterson-KFF Health System Tracker, 68% of insurers are requesting premium increases between 5 and 15% for 2026. That's the middle of the pack. But about 10% of insurers, they're proposing increases of 20% or more. A handful filed for over 30%. That's not a typo either. Now, why is this happening? Insurers point to underlying healthcare costs rising about 9% annually. That's the baseline, the floor, not the ceiling. But there's something else driving these increases, something most business owners don't talk about at the dinner table. GLP-1 medications, Ozempic, Wegovy, the weight loss drugs. 27 out of 96 insurer filings specifically mention GLP-1 drugs as a major cost driver. These medications can add up to 14% of premium costs. Now, I want to be clear. These are medications that genuinely help people. Diabetes management, weight loss, real health improvements. This isn't about blaming patients, but someone has to pay for them, and in the small group market, that cost gets spread across a smaller pool, which means businesses like yours absorb a bigger share of the impact. So what's the average damage? Kaiser Family Foundation puts it at $703 per month for single coverage, nearly $2,000 for family coverage. Multiply that by 12 employees. Add 11%. That's not a line item anymore. That's a strategic decision. Do you keep the plan? Or do you find another way? Here's where ICHRAs enter the picture. Individual Coverage Health Reimbursement Arrangements. It's a mouthful, but the concept is straightforward. Instead of buying one group plan for everyone, you give each employee a fixed amount of money. They use that money to buy their own coverage on the individual market. The money is tax-free for the employee. It's tax-deductible for you. And most importantly, your cost is fixed. You know exactly what you're spending month after month. Here's the growth story. According to the HRA Council, ICHRA adoption has increased by more than 1,000% since 2020. That's not steady growth. That's an exodus. Right now, somewhere between 500,000 and 1 million people are enrolled in ICHRAs and similar arrangements. And among businesses with fewer than 50 employees, adoption jumped 52% just last year. So why the sudden interest? Let's walk through what makes ICHRAs attractive, especially if you're running a small operation with limited resources and big responsibilities. Benefit number 1, budget predictability. With a traditional group plan, your renewal can swing wildly. One employee gets sick, your whole pool's rates can spike. With an ICHRA, your contribution is your contribution. $500 a month, $600 a month, whatever you set. Market volatility becomes the employee's variable to manage, not yours. Now, I want to be honest with you here, that's not purely good news. Because when individual market premiums spike, your employees feel that increase, not you. That's the trade-off. You're transferring market volatility from the company to the individual. For some employees, that works great. For others, especially lower wage workers, it can be challenging. There's a legal safeguard here. For 2026, an ICHRA is considered affordable if the employee doesn't pay more than 9.96% of household income for a silver plan after the allowance. If your contribution doesn't meet that threshold, employees can decline and keep their ACA subsidies instead. So, you'll want to run the numbers carefully, ideally with a benefits specialist who knows the current rates. Let's talk about who ICHRAs work best for. Because this isn't a one-size-fits-all solution. Your workforce profile matters a lot here. If your employees are scattered across multiple states, ICHRAs can be a game changer. Group plans often struggle with multi-state coverage. Individual plans are local by design. Same goes for workforces with varying needs. A 23-year-old single developer and a 48-year-old parent of 3 need very different coverage. ICHRAs let them each choose what fits. There's another scenario where ICHRAs shine. If some of your employees have coverage through a spouse, a traditional group plan forces you to offer them coverage anyway. That's money potentially wasted. With an ICHRA, you can structure contributions differently for different employee classes. Full-time, part-time, geographic location, even salary bands, different contribution levels for different groups. So here's what many small businesses are finding works. A hybrid approach. Offer ICHRAs to one class of employees, keep a traditional group plan for another. Match the tool to the need. Let's talk about the actual mechanics. Because the concept is simple, but the execution requires some attention to detail. Step 1. Calculate your current per employee spend on health insurance. Include everything: premiums, administrative costs, any employer HSA contributions. Get the full picture. Step 2. Research what individual market plans cost in your employees' zip codes. If you've got people in multiple states, this gets interesting fast. The variance can be significant. Industry data suggests $500 to $700 monthly for single coverage is a common ICHRA starting point. That covers a meaningful portion of marketplace premiums in most regions. Step 3. Talk to your team. Seriously, before you make this switch, have honest conversations. Some employees will love the flexibility. Others might be anxious about navigating the individual market alone. Set expectations clearly. ICHRA means more choice, but also more responsibility. Employees will need to evaluate plans, manage enrollment, handle their own claims. That's a shift for many people. Step 4. Consider working with a benefits administrator who specializes in ICHRAs. The setup isn't complicated, but compliance requires proper documentation. Let experts handle the paperwork. And here's something a lot of founders overlook. Review your contribution amounts annually. Individual market rates fluctuate. What's generous today might leave employees short next year. Now, let's address the elephant in the room. The criticism you'll hear most about ICHRAs, and it's a legitimate concern. According to Peterson-KFF, when individual market premiums spike, ICHRA employees absorb the full increase beyond the employer's fixed contribution. That's the trade-off built into the model. For higher-wage employees with financial cushion, this volatility is manageable. For lower-wage workers, an unexpected $200 monthly increase can be devastating. Some critics argue widespread ICHRA adoption could destabilize the individual market itself, shifting employer risk there and potentially driving up premiums for everyone. The counter-argument: the alternative might be worse. If premiums keep climbing at 11% annually, many small businesses will drop coverage entirely. At least ICHRAs keep employers contributing. Here's my honest take. ICHRAs aren't perfect, and results vary widely based on your specific situation. But for many small businesses facing unsustainable premium growth, they're worth serious consideration. If this sounds like something worth exploring, here's your homework. Pull your current benefits costs and do the math. What are you actually spending per employee? What could you offer through an ICHRA? Talk to a couple of benefits administrators who specialize in ICHRAs. Get multiple perspectives. The landscape is evolving fast and local expertise matters. especially if you have employees in multiple states. And have those conversations with your team before you make any changes. Transparency here isn't optional. People's healthcare is personal. They deserve to understand what's changing and why. The 11% cliff is real. It's hitting right now. But it's not the whole story. Business owners are creative. That's why we do this work. And there are paths through. If this kind of signal is useful to you, trends affecting small businesses, practical strategies to navigate them, consider subscribing. We cover stories like this every week. Remember, every business situation is different. What works for a 10-person service company might not work for a solo e-commerce operation. The principle holds, but the execution is yours to adapt. And of course, I'm not a financial advisor. This is not financial advice. Before making significant changes to your benefit structure, talk to professionals who know your specific numbers and situation. That number on Daniel's screen, 11% higher than last year, he's not alone, but he's also not trapped, and neither are you. I'm your host for Small Business Signals. Until next time, keep watching the signals that matter, and keep building something worth keeping.